Welcome everybody. It's great to have you joining the webinar today. Thanks very much to Taryn and to Taryn from Rampersand, Lynn from Luna, Dave Kenny from Hall Chadwick, and Jason from Cake Equity for joining us as well. I'll give a couple of, 30 seconds or so for a few more people to actually join the call, and then we'll jump right into it. I think there's a lot of great stuff to actually discuss today. There has been a massive shift in terms of the dynamics of capital raising in the startup market over the last 6 months or so. I'm going to kick it off. I'll run through a little bit of data that's just come out from a report from Silicon Valley Bank and Cut Through Ventures, which actually gives you an idea of how much funding has actually happened in the first half, and then some comparisons to the previous half as well. So my name's Callum Davison. I'm look after partnerships at Cake Equity. I'll leave it to Jace to do more of the intro on Cake Equity. I stole his thunder last time, but I'll let you talk to it more, mate. But yeah, as I said, today is all about actually giving a forum and tapping into some amazing expertise from across the startup ecosystem on what is happening with startup funding at the moment. And particularly for founders, how do they actually adjust their game plan for how they actually think about capital raising, how they engage with the investor community, even down to things like what types of instruments might they be using for their capital raise, etc. How do you adjust to this, right? And then how do you factor that in for not only the funding side plans for your business, but also your overall growth plans, and how you're actually going to manage that business going forward? Because even some of those things have actually changed as a result of the change in funding environment. So as I said, really happy to have the panel that we've got here today. We want to make it as interactive as possible. So please jump onto the Q&A, jump onto the chat as well. Drop your questions in there. We'll try to leave a little bit of time at the end to actually run through questions, but please don't leave them all to the end. Drop them into the chat, and we'll actually cover them off as we go through as well. So as I said, we had some great data actually just drop in the last couple of days from Cut Through Ventures, and I'll just share my screen here, and we'll actually have a bit of a look at that for you, and I'll kick it off with that because I think it really sets the scene for what's actually happening in terms of capital flow. So can everyone see my screen here? Jace, can you see that? Okay. So here's a summary of the report. So the first thing is that in the first half of 2022, we've actually seen $4.8 billion in funding flowing into startups in the Australian ecosystem. So while that's actually reduced, it's still actually a very high number in terms of the actual amount of capital actually flowing in. The interesting thing about that is if you actually look on it quarter by quarter, which you can actually see down in the bottom right-hand chart there, is the majority of that $4.8 billion in funding that actually entered, that was in startups, actually happened in Q1. So what does that actually mean? Well, in reality, pretty much all of that funding, even though it settled in Q1, would have actually been committed back in 2021, right? So you're just seeing an overhang of that coming through, and then you're seeing Q2 where the actual deal flow has actually dropped significantly down to about $1.2 billion, right?
Cal, I'll just jump in there though.
Yeah.
I'm sure this isn't only obvious to me, but if you look back only 1 year or 18 months to 2020, so Q2 2022 is still higher than any quarter in 2020. So it's always good to understand these things from a relative perspective. So interesting, isn't it?
I think that's right, Jason. I think that's one of probably the key points to actually take away is like, even if actually the deal flow for the remainder of the year continued at the same level it's actually been in last quarter, so $1.2 billion a quarter, 2022 would still be the second biggest year of startup funding in Australia by a country mile, right? Way bigger than what 2020 was or the previous years. So, yes, we have certainly seen it come off the highs of what it's been in 2021. But if you look at this chart, you'd have to say that 2021 was really an anomaly in terms of the actual capital flows that were flowing into the market. And we are still seeing deal flow coming through. So
it highlights one of the biggest questions for the year though, doesn't it, as well? And what does the next quarter look like? It's very hard to sort of look forward, isn't it?
That's exactly right. Yeah. so you get here, this is the, I guess, a year-on-year comparison, and you can see back here 2020, you can see 2021, which is outstanding, in a total capital raised over the year of 10.8 billion. And as I said, if we got another 2.4 billion for the rest of the year, it's still actually going to be a very strong funding year. It remains to be seen what will actually happen with that. Deal flow size, you saw quite a lot of larger deals that were actually done and probably dominated the investment flows into the first half of 2022. So there's a bit of a rundown on the individual deals here. I will actually send out a copy of this presentation so you can actually go through it in more details. We've got some data here by the actual funding round. So you can see the early stage seed round, Series A and Series B. I mean, the takeaway from this is pretty much all of those were affected, both in terms of the average deal size and everything. So what you're seeing is a pretty consistent theme that actually, valuations are under pressure, deal size, average deal size is coming back, and that's to be expected when we're coming off a sort of the highs that we've actually seen. And I don't know if anyone's got anything they want to add on that chart before we move on.
I'm sure we can talk through some of those concepts
Yep.
in the discussion later. Yeah.
Just a couple of other themes before we finish off on this one. So just looking at the actual type of startups, you can see that actually it's been pretty consistent where fintech and SaaS has really continued to actually dominate, both in terms of the dollars raised, but also the number of deals as well.
Interesting to see climate and clean tech there really sort of coming through and actually increasing.
Yeah, you're starting to see that.
Not many with an increase, even hardware. Maybe there was a few bigger deals there in hardware.
Yeah. And then we're looking at actually the mix of investment, particularly across, based on gender here. You can see that, despite there's quite a lot of noise and a lot of activity, I guess, around encouraging more investment, particularly into female founders. There hasn't been a huge change in that. There's been a bit of actually an uplift in terms of mixed gender founder teams, but not really significant. And overall, it still remains a minority of the investment flows through.
Just like to call out there, if you look at it in pure numbers, participation in completed deals, 8% versus 6% is actually a 1/3 increase in sort of, pure size. So that's actually pretty cool if that's a trend. The rest of them look pretty consistent. Yeah.
Let's hope it continues.
Yeah.
So
we certainly see a lot of great female founders, so I can't see why it won't.
So that kind of just sets the scene a little bit. So we certainly have seen quite a dramatic slowdown. The first half numbers that we've actually seen have been flattered a little bit by the fact that there was a number of deals that would have actually been committed back in 2021 that have actually settled in Q1. And then we've seen quite a sharp slowdown, notwithstanding the fact that $1.2 billion in a quarter is still much higher than what it was 18 months or so ago. So we're seeing a pullback, absolutely, but we certainly have seen continued deal flow. And the levels of that deal flow is actually not bad if you go back 18 months or so. So that sets a little bit of a scene for you. I'd now like to actually hand over to the panel to do a brief introduction to themselves, and then we'll actually throw it over and I'll ask some questions as we go through and explore the topic. So maybe Lynn, maybe you can actually kick it off.
No problem. Thanks, Cal. So hi, everyone. My name is Lynn. I am the team leader for virtual CFO advisory services at Luna Startup Studio. Luna provides a range of services specifically tailored to startups, venture capital funds, and other ecosystem players. And our services include legal, accounting and tax, education, and investment services. In relation to our panel topic today, at Luna, we focus on all aspects of the funding journey. So everything from involvement in pre-raise capital strategy, reviewing and having input into pitch decks, all the way to execution and business as usual processes. So yeah, thank you for inviting me to participate on the panel today, and I hope you will enjoy the discussion.
Thanks, Lynn.
Great to have you, Lynn. Hey, Lynn, sorry, before we go on, I was at your new Byron Bay office last month for the launch. Are you planning on getting up and joining in the Byron Bay action anytime soon, or what?
I am indeed, and also making use of the office surfboards, which have been installed. So
we have surfboards here too. We're not far from there, so make sure you come and see us when you do.
No,
okay, cool.
I will do.
All right.
Taryn?
Thanks, Carl. My name's Taryn Petersey. I'm a principal investor at Rampersand. We're a VC fund focused on early stage tech investing. We're fairly sector agnostic, but most of our time is spent investing in B2B SaaS, disruptive marketplaces, and where businesses are using data to build a competitive advantage. We invest, ideally at the seed stage and look to follow on at the Series A stage. And very proud investors in the cake business.
Thanks, Taryn. David?
And Rampersand are amazing, of course. Everyone, please make sure you reach out to Taryn and the team. Incredibly great investors to work with, great people. Taryn, are you a surfer, mate? Have you been on a surfboard before? If not, I know you're in Queensland at the moment, so we're going to have you down and get that first wave done.
Maybe in summer again, Jace. I'm a true Queenslander. I don't go in the water when it's this cold.
I'll absolutely accept that. We don't want to make the first one in this cold weather. Totally okay.
I'd just say before we hand over to David, if anyone hasn't seen the Giant Warm intro, if you're an investor and you want to get involved, then reach out to the team. Rampersand are actually, the drivers behind putting that together. If you're a founder wanting to get connected with investors, like there are some awesome investors that participate that, so don't miss out on that. And there's a particular focus there around helping also support founders that might not actually, might be from less advantaged backgrounds and actually wouldn't ordinarily have access into some of the top VCs in that. So if you know people or communities, please share the Giant Warm intro info with them, because it's an awesome opportunity for them to actually get in front of some of the most amazing investors in the country and really actually learn how they actually can get the funding that they need to actually build their startup.
Thanks, Cal, and thanks to Cake for supporting us with that event as well. But you definitely pitch that better than I do, so I'll get you to do that more often.
No problem.
How many investors? Like, there's a lot of investors involved in that event.
120 investors, and we already have 300 applications. So yeah, really exciting.
Yeah, congratulations, and definitely get involved if you're wanting to meet investors, raising capital. Even if you're not, get involved, meet these investors now, leading up to whenever it is that you might need capital. Wonderful opportunity.
Over to you, Dave.
Hi guys, David Kenny. I've been working in the startup community for about 22 years, helping companies spin out of universities. I've been involved with probably almost $1 billion worth of capital raising over that period of time. I've been in StartMate since almost day one, I think, and I'm the Sydney director for Startup Grind, and really just try and specialize in helping people raise money, win in global markets, strategic capital raising, essentially going global and working with people, founders. I just like working with founders, and I'm a partner at a chartered accounting firm called Hall Chadwick, and big fan of Cake, and I think it's a big element of helping people manage their staff better. So that's why I'm on the call.
Thanks, Dave.
Wonderful startup guy. Not many. There's not many people that I've met that have had more positive recommendations to talk to than David. And we've now got a really great relationship with David and with Hall Chadwick, and he's advising Cake. And so we're really, just excited to be able to work with such great people and to be able to bring them help bring them to the community to help us all learn and navigate all these challenges. So thank you, David. So I'm Jason from Cake. We are the market leader for software and solutions for equity in Australia, and we're expanding globally. So this includes employee equity, capital raising, and making sure that equity is a powerful tool to help startups grow instead of confusing and complex and broken and messy problem. We're passionate about helping startups, their team and investors to be able to use their equity to grow their business and realize value from that equity over time as well. We have over 1,500 startups in 15 countries now using Cake. And we're particularly excited at the moment about employee equity for global teams, which is, just such a big problem and something that we've worked out how to solve really well. So that's another little thing that we do. But today we're focusing on capital raising, obviously important for many startups and a bit of a tricky year. So excited to see what we can all learn and share.
Thanks, Jace. And thanks again for everyone for actually joining us. So that's awesome. I thought I'd kick it off today. The obvious question is like, are people still capital raising? Like we've just kicked over into Q3. Maybe actually I throw it to you, Taryn, to talk from a VC perspective, but I'd like to actually get everybody's perspective. Are you either raising at the moment, or are you as an investor investing, or are you actually supporting clients that are actually raising in the current environment? Is it still happening? So maybe over to you first, Taryn.
Thanks, Cal. Definitely still seeing a lot of people out there raising. From a deal flow perspective, May and June were two of the biggest months for deal flow that came through to Rampersand. So there's definitely, lots of new startup activity in the space, which is great. I think from the VC perspective side, a lot of VCs did kind of spend the last kind of 2 months, supporting their portfolio as a priority instead of having deal flow as a priority. And, really helping them kind of navigate the challenging capital markets that we're currently seeing, supporting them with some of those challenging decisions that they need to make. And also, with capital, where bridging rounds needed to be done, where, runway was shorter than ideal. So yeah, I think there's definitely still startups out there raising. VC funds are definitely still investing. I think there had been a bit of a switch to support versus new deals, but I think now with the new financial year and a lot of that, support of the portfolio company, we've broken the back of that. I expect this quarter will be quite active because there's some great companies out there raising at valuations lower than we saw last year. So there's good opportunities.
Buyer's market. Nice. Lynn?
Some of my insights from client experience is firstly to say that in the first 6 months of this year, deal flow has certainly been a lot quieter, almost half of what it was in prior years. So we've certainly seen a slowdown, and we've also seen that overhang that you mentioned. So deals that may have kicked off November, December, only closing Q1, Q2 of this year. And then, which is a point I know we are going to touch on, but I'll mention it now, just the actual instruments. We are certainly seeing significantly more safes and convertible notes in that fundraising mix. And to put it into context with our client base, so calendar year 21 and 20, we probably saw a third of the deals being safes or convertibles, whereas for the 6 months year to date, granted in a smaller sample set, we're seeing more than 50% of the deals being safes or convertible notes. And that could be a factor of the market sentiment, valuation concerns, but also maybe the market being more confident around safes, or understanding and a greater awareness around the instruments themselves. So it's hard to say.
Awesome. And Jace, do you want to even pick up on that one? What you're seeing in terms of activity, but also even actually why we might see more people using safes versus a priced round?
Yeah, so, sometimes we're echoing each other. Sometimes we have different points. I think certainly, echoing where Taryn was coming from, certainly seems to be a lot of, because we've done several of these events, Cal, and, Cake's been raising and we've got quite a lot of context. One thing I'll highlight, and you'll see this on LinkedIn, there's a lot of funding still out there. There's, Lightspeed just announced this week a $7 billion fund. There really is still a lot of capital available. So that's something to bear in mind. And I think that lines up really well with what Taryn was highlighting about that really, going back into deployment in the second half of this year. I know that, Cal, when we had the event last month with Lantern up in Singapore, their strong view was that while we had a period of I guess, freeze with regard to new investment, they were looking to this quarter, perhaps around September, to see, activity for new investment. And these are just opinions, but they're from industry leaders. So passing on a little bit there. I think Birchall, we've got a really good relationship with Birchall, and they had some numbers out from just last quarter. So they had 24 EOIs launched, 27 offers launched. So that more offers than EOIs. So that's pretty good. That's a bit confusing. So there must have been more EOIs the previous quarter. 20 offers funded and over $17 million, going through. So crowdfunding still, working really well. And that was, I guess, a point that I was also going to highlight, I think, and I'm happy for the other guys to sort of jam on this a little bit as well. But I think the smaller investors are a bit more active than the larger investors. And it could just be a function of the smaller investors not necessarily having the responsibility of protecting portfolios and having to assist with restructures and hard decisions, and then obviously the professional investors have the obligation of leading things and all that hard work that goes into that, whereas angel investors and those smaller checks can sometimes be a little bit quicker to operate and not have that level of professionalism. So I think smaller rounds have been a little bit easier to come by from what we've seen. So yeah, just there's some insights from me. I don't know if you want me to cover the safe piece as well, but quick, obviously, yeah, we're seeing a lot more safes and convertible notes. I think that one or the other, depending on what your lead investor and your community likes, is kind of, they're both sort of 6 of one, half dozen the other to a degree, and very important in a time like this. And we can go into why if we like, but yeah, totally agree with what Lynn was saying there for sure.
I just to pick up on that point around some of that earlier stage funding, Jay. So I mean, certainly, I was on a call with a Hustle Fund that it does pre-seed investment, and they do like 100 investments a year. They were saying they're still actually keeping up that cadence. We're working with Wavemaker VC, who's doing early stage funding up in Southeast Asia. They're actually looking to keep their cadence up. Certainly the accelerator programs where they're tipping in a bit of money as well seem to actually not be looking, Antlers, etc., aren't looking to actually pull back. So I think that early stage seems to be like there's still a fair commitment, and if you're tapping into one of those sources, there's actually every chance that you'll actually still get that funding done.
If I could quickly add to that, and this is my own personal experience, I've got some grey hairs in here now. It can be the case, and it's sort of seeming to be the case, that with these, more longer term macroeconomic cycles, that at the beginning of the cycle, investors are more likely to invest in the earlier stage with the expectation of realizing towards the end of the cycle. So they run on a 5 to 10 year cycle. So they want to get their money in hard in the beginning of the cycle, which could be now, if you're using the 7 to 10 year principles that many of us do, with a view to them maturing through the rounds and exiting, 5 to 10 years from now. So for all the founders out there, it's kind of worth understanding that when you're planning. Yeah. Sorry, didn't quite get that out, but I think that kind of makes sense. And I'd love to get other people's opinions on that as well, if that's relevant.
Well, I mean, I'm seeing a little bit the other way, that there's been some really good rounds out of the US for Australian companies like Tiger. And, whilst they've run out of money, theoretically, if you're good enough, you get the money. So same with Australia, lots of good VCs investing in good companies in Australia too. It's all about whether or not I think you deserve the capital. If you're doing the right things and you've got your team right, you've got your product and your traction, your trajectory, you're going to raise money.
You're more maybe seeing the quality piece. Mm-hmm.
Yeah, maybe a little bit more slower, and maybe more early stage marginal things might struggle more because of that contagion effect. But there's plenty of deals happening. I reckon it's just as fast. I've slowed down slightly just from COVID but that bow wave of keen investment is definitely out there.
Yeah. So I've heard that
yesterday someone was saying, the capital raising Armageddon or whatever. I really don't think that is where we're at. I don't know what the panel thinks across the panel, but I think it's a really good point that David's making there.
I think it's the experience is unique depending on what stage you are at as a business, and probably there isn't one blanket opinion on the process that we can make as a panel. But yeah, just it is unique and an element of luck as to where you are in your journey.
I think you just got to look at it and say there are macro issues, but that doesn't change how good you are as a founder. If you're good enough to raise money and keep your team focused and keep your product on point and keep your development team doing the things that they need to do, you're going to raise money. It's like, okay, it's risk on, risk off. That happens in every market, from 2000 to 2008 to GFC, and even when COVID started. people were still raising money. Even in the US, I think they deployed $40 billion it was a $10 billion swing downwards, but that's still $30 billion that went into the market. And Australian VCs are still investing. So I think people look for reasons why they're not, raising money sometimes, and often it's internal. It's not because there's less money, because there's not less money. There's still plenty of money out there, and you've just got to get in front of the right people and audition them rather than having a begging bowl out. And you just got to keep focused. And if you do that, I think most people that deserve the capital will definitely raise. So at least
I think that's right, David. Like, a lot of VC funds did go out and raise, decent sized funds last year. So there is capital to be deployed. It is going into the quality businesses, but also there's that time piece, which we'll probably go into more detail. People were used to getting, term sheets quite quickly and funding, within a month. It's not that businesses aren't getting the funding. It's just that, that expectation around, oh, I'll go out and have 5 meetings and I'll get a term sheet, probably needs to switch. There'll be a more of a relationship building, a more of an alignment of how you're planning to grow into the future and your future plans between your funder and the startup. And that piece is, going to take a bit longer than it did before. So the capital is still there. It's just being flowed into the quality companies, and, a bit more alignment and diligence is being done, hopefully on both sides, to make sure you're partnering with the right person when you are taking capital.
Couldn't agree more.
Yeah, no, I'd definitely say that the whole courting phase is taking longer, as well as the deal finalization. So the combination of those two means you need to get out there as early as possible to make sure you get the money when you need it.
I think, I think, I know it's something that, Jason, we talk about a lot, is actually, when you're actually looking to fundraise, it's actually, investors are doing due diligence on you, but really the founders need to do DD on the investors as well. And they also really need to be realistic around what investors they're talking to in the first place. Are they talking to enough of them and everything? And I guess in the current environment, that becomes even more critical, right? That you're actually understanding who you're talking to, that you're talking to the right people, that you're talking to enough investors,
enough
etc.
people. I think the biggest mistake people make, they don't talk to enough investors. It is such a matchmaking exercise, and there are so many variables. And I really feel like, it's just the amount of work that goes into it, the amount of meetings you have to have, the amount of follow-ups, and this is nobody's fault. This is the process. And I feel like accepting that and really engaging in that and just really doing that work that needs to be done is something that people can sometimes not quite be aware of and executing enough. Because certainly on our side, it's we respect the process. We really work hard and do the work, and and then you see the results. And not that I'm trying to hassle any founders out there either. I'm just trying to give some context to to the process. Yeah.
I just add to that, Jason, is that sometimes the funding that you need may not necessarily come in one big check. It might, involve smaller parcels of money from different investors through different instruments. And I think, as a founder, just being open to the fact that it won't necessarily all come in one go, and having that plan B, C, and D, if plan A doesn't necessarily eventuate.
Awesome. Taryn, you mentioned...
Got to do whatever it takes, Linda. Yeah, whatever it takes.
Plan A
mentality.
Taryn, you made reference before to the fact that, certainly the last couple of months has been a lot of work from you doing work with your existing portfolio companies to make sure that they're in good shape for a change in the environment and that. Could you maybe talk a little bit about that and actually about where that kind of focus is going? And in particular, you hear about the capital efficiency versus growth trade-off. It'd be great to actually hear from an investor's perspective around kind of how that's playing out.
Yeah, thanks, Cal. Capital markets were hot last year. And so startups were really rewarded for just growing top line revenue growth at all cost. And that's what set you up for a great Series A or a great Series B. And that's what the markets were expecting and demanding of you. I think now with the capital markets cooling off a little bit, it definitely has switched to, rewarding, growth at an growth, but efficiently, not just at all costs. You know, you can't now predict, no one is really putting a prediction down on when, you know, things will return to some form of normalcy, when capital raising will be a little bit more predictable, I guess, back to where it was, if it ever gets back to where it was last year. So yeah, it's kind of, okay, well, don't grow at all costs. You've got X dollars in your bank account now. Ideally, use that money to get yourself to break even if you possibly can, or to a place where a small amount of equity will help you unlock that next milestone. Maybe you can access venture debt at that point as well. So yeah, so there's going to definitely a trade-off now between growth, but making sure that's being achieved at the right level of burn. And as we'll, you know, investors in 12 months time aren't going to be like, oh, well, you only grew at, you know, 2 times revenue instead of what we've been seeing previously, which was 3 or 4 times revenue growth. They'll be like, oh, you grew at 2 times revenue, but you did it really efficiently. Great. Now, when we give you X dollars, we know you can use that to grow, you know, even more into the future. So I think there's definitely a focus towards that efficiency, definitely a focus to trying to track and build a business, which is kind of, they like to call it like default alive or default investable. And I think this is just an opportunity for startups to, like, you're not on this journey alone is probably the other bit I'll say. It's, you're not, your VCs aren't out there saying, you know, you've got to go grow efficiently, just get it done. We're here to help. We'll help you make those decisions on where you should be investing the capital you have, where it might be some opportunities to cut some costs, where there might be an access to capital pools or doing smaller bridging rounds. And so, yeah, I think my key takeaway there is definitely efficiency of growth is being a focus for now and into the future, but also make sure you lean on investors and advisors to help you on that journey.
Great.
Dave, you quickly on that, just from my experience. So it has been very valuable to have quality investors around during this period. You know, I do have extreme confidence and belief in the Cake team, but having, you know, Jason Calacanis and his team and Taryn and the Rampersan team around to help us navigate the period, and you know, they have such a wealth of knowledge, and yeah, it's a big advantage. So yeah. Sort of throw that in there.
Awesome. Dave?
I was going to say that the slowing down isn't always the right thing. And also the other point is that sometimes having too much money is a bad thing too. So there's no absolutes in any of this, because if you've got too much money, you never really learn to live scrappy. You never learn to understand your unit economics. So it just depends on the team. What do they need? What are the resources they need? And as you said, Jason, having good people that can bring something to the table, not just money, that's invaluable. So auditioning investors, making sure that they're not telling you what to do after, they're just asking you good questions, because ultimately it's the founders that are going to make these decisions. And you know, good founders will ask good questions and listen, and hopefully they'll make better decisions with their capital, because not all companies need to slow down. Not all companies need to lay people off. And if you spread your investor base too widely, it's hard for those investors to really have a deep knowledge of what's really going on under the hood of the business. So getting closer to investors is really important now, rather than, I think, just looking for new ones, because you'd be doubling down on your relationship with the good investors in your camp right now. So sharing those bad news early, or asking for help or questions. This, I think, is a time for attacking, not for retreating.
Good, great point. I guess a related question to this, which we've had come through the chat, is just about the mix of deployment of capital, right? So, you know, there's points made quite a lot that, you know, there's been a lot of funds raised by VCs over the last 12 to 18 months. So there's a lot of powder that they've got, and you know, they've got to deploy the capital or whatever. It'd be great to actually kind of just get any observations we've got around, you know, the mix of deployment of that against for new investments versus actually supporting existing portfolio companies, but also maybe around, is there a real pressure from investors' perspective to deploy that, or is it, you know, whereas previously they might have been doing it over a shorter period, they can now just spread that out. So it'd be great to actually get a couple of perspectives on those 2 points.
I can jump in there as a starting point. So we are in the process of raising, but also actively deploying our fourth fund. So we've been doing a lot of work around our portfolio construction and how we'll allocate that to new startups versus follow-ons, and really strongly following on to the ones that are doing incredibly well. So I would say, most probably there's definitely some funds there that just write checks and scattergun approach, and they don't ever follow on. Whereas I think most kind of the slightly bigger funds do have an allocation to follow on. In this environment where there's bridging rounds, it's actually a good opportunity for us to, where we believe in the company still, deploy that follow-on capital before the Series A, maybe in a bit of a seed bridge situation, so we can come in, deploy a bit more capital when the valuation hasn't yet grown too much, and that's a good opportunity for us. But we are also still, trading that off against risk. It's very different deploying $1 million into a Series A company, which has got a few more things worked out than, kind of a seed business as well. So it's constantly a trade-off that we're thinking about. There's not any particular set rules, but I would say most funds have that follow-on pool of capital and that initial pool of capital. And if they're, a relatively new fund, they're at the moment deploying a bit of both. There was a second part of your question.
It was more just, is there pressure on the VCs who, you're raising around now to actually get that out the door in a certain amount of time, or can you actually be patient and like how's that dynamic likely to play out?
Like, I don't think, probably more personally, we've never had the pressure to deploy. It's always about finding the best companies and doing it that way. So I think pressure to deploy is just, if you want to raise a new fund, you've got to deploy the last one. And I think with a bit of uncertainty on whether fundraising for funds will, how that is going to change over the next 12 to 24 months, there may be a view to deploy slightly slower, saying that, Archangel just got a $25 million fund off the ground pretty quickly. So perhaps everyone is seeing this as a great opportunity to invest in funds and be part of, this cohort, which we know, the last time there was a big downturn, this was kind of the best vintage of VCs out there. So it's kind of down to the individuals to whether or not they invest in the funds, but I don't think the funds feel that, we don't feel that pressure to be deploying quickly.
Yep, great.
But there's some truth too in backing those early stage ones, because then only then those good founders really want to keep you investing with them, over and above who gets those extra preemptive rights. My favorite investor. So the best companies want the people to back them now. I think this is a great time for VCs to back good companies.
Yep, great point. We've got a couple of other questions here from the in the Q&A. So one was just about crowdfunding. Jace, I don't know if you've got anything to build on, on crowdfunding and then what types of actually investments work pretty well in the crowdfunding environment.
So without being a crowdfunding expert, I've just been around the space long enough to know a few things. It's called crowdfunding because it works for companies with a crowd. So I think the secret's in the name. So you're normally better off choosing that channel if you're B2C, or if you're a B2B in a way that has a lot of followers. So perhaps you've got a really good social media, you've got a good network, and you can tap into that crowd to fund your company. I think one of the mistakes people can make with it is that they think that they bring their company to the crowd. And while that can work and does work to a degree, I think it's best to think of it the other way around, where, hey, I've got this crowd, would they like to fund me? So, things where there's wide engagement with society and you're really touching a nerve that's quite trendy or very relevant, works generally better. So that would be my general comment about crowdfunding, if that's helpful.
Yeah. We've got a couple of more questions also around the sort of safes and con notes and why they might be used in the current environment versus price rounds, and is there a reluctance to do price rounds in the current environment? So who wants to actually talk about that dynamic a little bit?
I can touch on, in terms of safes and condos, they often, they have a role at various stages, but when there's some uncertainty around valuation, it's a way to get funding into the business when it may be hard or tricky or for other reasons. You can't come up with an agree on a valuation, so it kind of kicks that can down the road a little bit. But yeah, in terms of the price rounds, I just think that there are a lot more, tighter restrictions that are being put on price rounds, and warranties and investor insurance, anti-dilution clauses that, are more prevalent than they were previously. And that just may turn away certain founders from considering those as instruments. But safes tend to, you be able to get one off the ground far quicker than a priced round generally. So.
That's a really good point. So I guess talking about the actual deal terms, Lynn, there. Certainly last year I heard a lot of commentary, probably mainly coming out of VCs, complaining about, the deal terms that they were being forced to actually take, and that they weren't actually fair and reasonable, and the market was.
You mean like uncapped safes with no discounts? I remember Rain complaining correctly about that. I think even bloody Y Combinator's now doing that, but or was doing that. It'd be interesting to see what they do this year. They just announced the big uncapped safe. Yeah.
So it'd be great to actually get, so what is happening with those deal terms? It seems like the pendulum swung back a little bit. What are we seeing with that at the moment? Are we seeing, it go to a point where the deal terms are swung way back in front of in favor of the investor, and they're not founder friendly, or what are we seeing?
Can I make one comment, which is like, a safe's not a safe's not a safe? I think it was one of those things where there's just so many ways to do one. You can have a very professional looking safe led by a VC, which looks much more like a regular venture round, or you can have a safe where like 10 people sign 10 different documents. I would recommend doing that, but you sort of can do that. You can have a safe that closes over a long period. You can have safes that, it's a very flexible instrument. So I think depending on what stage you're at, very early safes look a little bit different to later safes. And I think it's important to be aware that there's quite a lot to that instrument, which is a good thing because there's flexibility, but you can also make quite a few mistakes if you don't understand what they're good for and how to use them.
I think you go back to Y Combinator that mentioned earlier. They invested in 100 companies, so it's impossible to come up with a single valuation for every company in the cohort. So that's the origin. But if you're an angel investor, you probably want to spend some time and have a think about what you think the company might be worth in the future. And there's so many downsides for using safes. As you said, Jace, there's lots of different terms, caps, discounts, uncapped, and you want something simple. And if you can do a price round, even if it's slightly lower and you're just taking just enough money, great. And run a mile from a convertible note, because that's debt. So, talk about not being believed in. So I think that, and you also forego potentially the ESIC concessions. So there's a lot to be said for, keeping it simple.
And there's a valuation cap too, which can act as a quasi valuation, but you haven't done a valuation. And if you don't understand what a val cap is, you might have a discount. So there's a lot of complexity with the safe. So someone asked, are they easier? I would argue that if they're done well, they can be cheaper and easier to implement, but there's actually quite a few things that quite a few problems attached to them that aren't always evident, as Dave's highlighted.
Yeah, and they're a bit of an optic for the next round too, to say someone's getting to convert at $5 million, but now I want to raise at 20, and you're going, well, hang on, have you really gone up that far? And so there's all sorts of problems with safe notes, but good companies will get good terms. Simple as that.
Taryn, do you have anything to add on the terms?
Don't be scared to use them because they're very common this year. We're not trying to scare you away from them. I guess we're just trying to highlight a little bit more about them. Yeah.
Yeah, I think from our perspective, when there is a bit of movement in valuation, it is a bit hard to kind of put a specific line in the sand. There is some kind of good protections in terms of valuations from the safe notes. And also similarly, like they can be when they're done well, which we hope we do well. They can be pretty quick and easy instruments to implement. So if you're trying to just do a quick bridging round, getting people signed up to those can be quite easy. So, you know, we're flexible with the structure that we look at. And like, I think from a valuation perspective, they are making a little bit of sense now, rather than going into the subscription documents, not subscription, the shareholders agreement, and putting in some, you know, complex downside protection terms, which then at the next stage, you know, might also be disadvantage to us as early stage investors, and might be hard to remove with the next round investor who's leading the round. So we do definitely weigh that up. We don't want to put in terms which are unfounder friendly for the founders, because long term we're super aligned with their success. It will, you know, lead to our success. So kind of putting in these complex terms really long term isn't beneficial for anyone, and in the short term is really just complexity for valuation protection.
Yeah, I think that's a point really well made.
I wouldn't mind expanding on that a little bit, just from a founder perspective, and just so that we got everyone has a good understanding of what can happen with a SAFE. So just say, for argument's sake, raising 2 million on a SAFE with a 10 million cap, it's 20% dilution if it's converted at the cap. But you do need to be aware that it might not convert at the cap, and the next round might be at 5 million. And so obviously that's not the expectation, but that can occur. And so it's really important when you're thinking about how much to take on with a SAFE and you're not taking the equity position at the time, to just think about that. What are the, you know, what is the range? Ideally, you know, you do your next round at 20 million and then it blends out really nicely. You get the 2 million convert at 10 million, and then you get the next chunk at the higher val, and, you know, the company's firing ahead. That's really nicely balanced for everybody. But just do be aware that just in case the next round is at 8 or 6, just do that modeling just in case you might actually just make a mistake that you're not expecting.
And that's a very good point, Jason. With, like, you know, valuations coming off a little bit, make sure that you've run various scenarios on what the business could be valued at before you sign up to anything, really.
Always look forward 1 or 2 rounds with your cap table modeling if you can. Talk to someone like Lynn or Dave, or talk to your investor, or talk to, you know, probably not someone at Cake. We can do it, but we'd normally refer to you as a partner. We do have a modeling tool. Our modeling tool's just gone live. I've been asking for it for several years. The engineers have just launched this week our round modeling tool built into Cake. So you can go into Cake if your cap table's in there and look forward around. That's pretty cool. But I nearly forgot to bloody mention that, Cal, but that was a cool little thing. So you can do that in Cake, but it is important to look forward and do some scenario, you know, just think of what about a good situation? What about a bad situation? It's good sort of capital management. Yeah.
Jace, like, what I guess a follow on from that, which would be good to actually, you know, to get your perspective on and other people's perspective, is, you know, there is a real bit there, you know, there's about, we talked about capital efficiency and actually pushing back to actually how do we actually get back to break even sooner than what we would have been thinking about maybe 12 months ago. You know, there's a big focus on how do you actually extend that runway in that as well, in that scenario, and be capital efficient. You know, be great to get some of your insights around what are some of the things that you're actually thinking about as a founder for Cake, but also seeing other people actually think about and implement to actually, in order to actually reduce the reliance on capital raising and extend and make that runway extend.
Yeah, well, look, I think the first thing before going into any actual round is to plan out your financials, plan out your company, plan out your strategy, plan out the corresponding financials. You know, you never go into fundraising without doing that. Fortunately or unfortunately, a bit of both, really. We're operating in an environment where there's more pressure on that than ever. At Cake, we are taking it as a real blessing. We're a little bit fortunate at the stage we're at because we now have, you know, a reasonable amount of ARR. We can plan it at a different level, and that's like a wonderful situation to be in, and we're all in a different situation. But I think looking at your cost per acquisition, looking at your CAC, looking at your magic number or your payback period, LTV to CAC is not as good because it's not as short term, and it can get hidden behind like long lifetimes and isn't as relevant over sort of a 12 to 18 month period. So I think the most important things Look at your costs, make sure that you know kind of what your fixed costs are, if they can be lower, like get them to a level that you're happy with, and then look at your unit economics and see when do those, when does your break even essentially kick in, and that is essentially a function of your revenue per user and your CPA and your CAC, and getting that into balance as quickly as you can. I was working with we do some investing as well with Palm Beach Ventures, and talking to one of our companies the other day, and I said, well, what's your CPA, what's your CAC, and what's your, and they were in a really tricky situation where they just didn't have the right balance, and that's so difficult for people to invest into right now. So I think you really need to understand how to get customers for as little as possible, how to make sure that the payback period is within 12 months or something like that. And those type of companies, I think, are much more likely to be supported in short to medium term, at least, or always, but certainly at the moment. That'd be my comment. And anyone, I'm sure this panel's got, and look, Darren's helped us and Dave's helped us. So, you just got to talk to awesome people that you have around you to tackle these things. Maybe it's a growth advisor to get your ARPU up. Maybe it's like a better, someone that can get your CPA or your CAC down or whatever, but you just got to tackle this stuff in the best way that you can, and be able to tell that story in a very compelling way to get the support you need.
To that point, Jason, certainly, if you're pre-product market fit, the quicker you can get to that product market fit, the more, comfortable your fundraising journey is likely to be. That's the first point I want to make. And the second point is just around the opportunity that a downturn presents. Everyone's, can get hung up on the bad sentiments, but if you think about some of the most successful startups have come out of a downturn opportunity, and those that are scrappy and have the grit to kind of push through the stage could come out being some of the most successful businesses in our lifetime. So.
Yeah, the founders I admire the most, they have done the most amazing stuff to bring money into their company over the time, and you're just always in awe of some of the creative ways that they're able to do it. And think of a concept, minimum viable business. Don't think necessarily MVP right now. I would be thinking, what's the minimum viable business? It just gives you a lot more of a balanced view of how to think about what you're doing.
I think. Sorry, Dave. Yeah.
I was going to say the danger, I think, of looking at metrics is letting founders think those metrics that apply to other businesses should apply to mine. It's really working out what are the key metrics that are going to demonstrate what's working, what's holding them back. There's different metrics at different stages that a company needs to focus on, and they can get totally overwhelmed with the huge amount of information that's out there, but they don't know which are the levers that they should be focusing on for their business. And that you can't tell someone that. You've got to really understand where their product is and how close to market they are, or if they're in market, what's working, where are they attack. They might think they've got product market fit, but they've got the wrong customers. They may be overpaying for things, and you can't give advice. You've just got to ask good questions. I think that's the key thing for me.
Great point, David. I think just following on with the theme we're talking about there, as well as last week, and I think their roadshow is still underway, but we joined Tractor Ventures, and they're talking about venture debt or revenue based financing models. We have taken advantage of various grants, particularly we're looking at those at the moment in terms of how they're helping us at Cake with our international expansion. And then, one that's very near and dear to our heart, as well as the whole employee equity bit, right? And that's not just for employees, but it's also for rewarding great advisors who you actually want to get on to actually help your startup, and then also maybe contractors who are doing sweat equity for you and that. So, all of those things are also, I think it's really important that people are actually keeping an open mind around those things and actually bringing them into the mix, and maybe working them a little bit harder than what they might have done 12 months ago, because they could just turn on the capital raise tap and do that, but they need to actually think about working those harder and tapping those other sources as well.
100%.
So we've got about 5 minutes to go. So if there are any other questions, please drop them in the chat now. One that we haven't really got to that came through early on from John in the Q&A was just around the, actually, sorry, it wasn't actually John, it was another one, but it was actually around, are there any particular sectoral themes that you're seeing come across at the moment where maybe one of the sectors is a little bit on the nose at the moment or whatever? I know this is a constantly changing thing, but it just, if anyone has any insights on that, so a little bit of data from the cut through ventures, but yeah, if anyone's got anything to add on that, it'd be great to get your thoughts.
I think the other thing I'll say to that, Carl, is people are tending to kind of invest back where they're a bit more comfortable. So, you know, when people were doing investing in some random things or putting out some like broadening their scope historically when there was lots of opportunities and exciting capital raises out there, I think, you know, investors are refocusing back on sectors that they really do understand the metrics, they really do understand the drivers, so that they know, you know, when they invest in a business, they've got a great playbook to help those founders navigate these times, grow efficiently. So you may see some, I guess, VC funds revert back to a bit more of what they're good at versus kind of, you know, looking at the whole market and getting excited about absolutely everything. And hopefully that means if you find the right advisor, they'll be really able to help you in some of the key drivers for your individual business.
Awesome.
I saw health tech was pumping.
I was just going to say, I don't care what sector something's in. If it's 10 times better and there's a business model around it, and good people that want to make it work, I don't think there's any specific sectors that are off for innovation. I mean, everything can be innovated.
Yeah, great point. I guess just to wrap it up, you know, it'd be great to just get you know, one or two tips from each of you in terms of, you know, we're really mainly got a lot of founders on the calls today. So if there's one or 2 points that you'd really like them to leave them with about things they need to think about, capital raising in the current environment, what are they? And I might just go back to the order that we had previously. So maybe Lynn, if you could maybe kick that off.
Sure. I mean, we have touched on a few of these already, but just to recap again, starting as early as possible, building those relationships with investors and building trust, building confidence in your business case, getting those runs on the board. And yeah, the second one being, you know, having a plan B and C, and as Jason touched on, you know, really modeling those scenarios out. And you may, in this environment, have a few more scenarios than you otherwise would have, but just kind of making sure that you know, consider the broad range of options of how this downturn may play out.
Great. Taryn?
Thanks, Cal. I'm just going to echo Lynn's point. I think, you know, building those relationships with investors and making sure when you are ready to raise, you've kind of connected with the right investor who's aligned with your vision of how you want to grow the business is super important. And Cal, I'll just reiterate that if you're a founder, early stage founder looking for that first introduction to an investor, Rampersand, supported by over 100 investors and angels in the ecosystem, is running the giantwarmintro.com. Cake's a huge supporter of it. So please do sign up if you're looking for an introduction.
Awesome. And I think, yeah, I'd add David's point there about, yeah, it's not only actually doubling down on the actual relationships with new investors, but actually also doubling down on those relationships with your existing investors. I thought that was a point really well made, David, that maybe sometimes people actually forget a little bit as well. So David, your kind of parting points?
Okay, so I think three key things. Getting really honest with your investors and saying and going through what those challenges are or will be, so that there's less surprise. So sharing that bad news early, getting even closer to your customers, because the last thing you want is churn on revenue. So really understanding how important this is into their business, your product. And the final thing is, which I think is a good point for Cake and everyone that's got employees, don't just optimize for tax. Don't just hire people locally when the best person might be overseas. Don't hire people just because you can get R&D. The best person may be overseas. Don't optimize for tax. Optimize for the best fit of the person every time.
Yeah, awesome. Thanks, David. Jace, final word.
Yeah, so I guess founders out there, this is your time to shine. Be creative, show perseverance, do the work, be resilient. Let's look after each other. Reach out to your network, and look. There's definitely a hard way and an easy way to capital raise. We've got a capital raising toolkit. I'm sure Cal will be sending it out after this. So do get into that. You can save yourself. It's free. You can save yourself just a lot of time and hassle working through the process. And yeah, we're here to help if you need anything.
Thanks, Jace. Thanks again for everyone for the panel for joining us today. Some amazing expertise we've got on the line today, so that's fantastic. Thanks for all the founders and everybody else in the startup community that's joined us. We really appreciate your time today. It is an interesting time, but one of a couple of the key themes that I really heard come through, you can see it in the data. There is still funding there for the right founders and the right ideas. So, persevere. You do have to make some adjustments, which is cool, but just make sure that you're actually smart around that. And I think one, Jace, that you always say is as you're going through that journey, make sure you're tapping into the right advisors and people to actually support you on that journey, which is really important as well. We will send out some link to the recording. I'm sure both Lynn, Taryn and David, and I know Jace, a lot of people reach out to him. So if you want to hit them up on LinkedIn or whatever, I'm sure they're happy to answer questions as well. Thanks again for your time today. Really appreciate it. And hope you have an awesome week. Thank you.
Thanks, everyone.
Thanks, everyone.
Bye.
Happy raising.